Good afternoon. It's my pleasure to welcome you to this afternoon's event on the Federal Reserve and financial stability risk. And I'd particularly like to welcome our great line of panelists to address this timely issue. In the order in which they speak, they are Yan Hatzius, who's chief economist at Goldman Sachs. He'll be followed by Bill Nelson, who's chief economist at the Bank Policy Institute. After that, we'll have Robin Brooks, who's now a senior fellow at Brookings and was formerly chief economist at the Institute of International Finance. And I'll be the last panelist. And my good friend, Alex Pollock, who's a senior fellow at the Mises Institute, he'll moderate today's session. By way of introduction, might I say that we live in an age of great monetary policy experimentation. First, in response to the 2008-2009 Great Economic Recession, and then again in response to the 2020 COVID-induced recession, the Federal Reserve pursued a highly unorthodox monetary policy. It maintained interest rates at the zero bound for a prolonged period. It also expanded the size of its balance sheet by a staggering $8 trillion through its bond purchase programs, and it allowed the money supply to balloon. This appears to have contributed to a surge in both inflation and asset price inflation, and it also led to a relaxation in lending standards. Beginning in March 2022, in response to a surge in inflation, the Fed has slammed on the monetary policy brakes. It is engaged in the most aggressive interest rate hiking cycle in the post-war period. It has reduced the size of its balance sheet by over $1 trillion, and it is allowing the broad money supply to contract for the first time in the post-war period. At the beginning of last year, this shift from ultra monetary policy ease to substantial monetary policy restraint contributed to Silicon Valley Bank and First Republic Bank failures. Those were the second and third largest US bank failures on record. They required heavy intervention by the Fed and the Federal Deposit Insurance Corporation to prevent those bank failures from becoming systemic banking sector issue. At the same time, the Fed's newfound monetary policy hawkishness has caused large mark-to-market losses on the bank's bond and loan portfolios, and has exacerbated the commercial real estate sector's problems that have been brought on by changed working and shopping habits. In recent policy statements, Fed Chair Jerome Powell has indicated that inflation is proving to be more resilient than had been expected, and that the Fed will need to maintain interest rates high for longer if the Fed is to meet its 2% inflation target. This makes it particularly timely to have a discussion of the risks that the Fed's policy might now be posing to financial stability. To frame the discussion, I've asked the panelists to address the following questions. How much of a risk do high interest rates pose to financial stability? Second, the Fed's high interest rate policy has caused around $1 trillion in mark-to-market losses on the bank's bond and fixed loan portfolios. How much of a risk does this pose to financial stability? Next, what are the implications of the commercial real estate crisis for the banking sector in general and for the regional banks in particular? Another question is, in past episodes of a prolonged period of ultra-easy monetary policy, there have been unhealthy buildups of leverage that were revealed after interest rates were raised. How concerned should the Fed be about the financial system leverage that was built up during the prolonged period of zero interest rates and asset price inflation? And finally, we have an ongoing Russia-Ukraine war and the risk of a widening in the Middle East conflict. What are the implications of these developments for US and world financial stability? So without further ado, I'll ask my good friend Alex Pollock to start moderating the session. Alex, the floor is yours.
Thank you, Desmond. And it's a real pleasure to be able to moderate such an expert and knowledgeable panel today. Let me add my welcome to all who are joining us. by Zoom for this most timely and pertinent discussion of the Federal Reserve and financial stability risk. William G. McAdoo, who was Secretary of the Treasury when the Fed was created, notably proclaimed in 1914 about the new creation, "The Federal Reserve banks will give such stability to the banking business that extreme fluctuations in interest rates and available credits, which have characterized banking in the past, will be destroyed permanently," said McAdoo in 1914. Well, with our perspective on all the financial crises since then, we know that was probably a little over-optimistic. And we know that the Fed is not only observer and monitor, but cause of some of the instability, at least from then till now. Desmond mentioned the giant interest rate risk losses of the banking system. Take Silicon Valley Bank, for example. Basically, Silicon Valley Bank just made itself into a really big savings and loan. Its principal investment was mortgages, mortgage-backed securities of the 30-year fixed rate variety, which it funded short. What a surprise that it got into trouble. But Silicon Valley Bank was just following what the Fed itself was doing with its own balance sheet. And SVB apparently believed the Fed's assurances and the Fed's forecasts of continuing very low interest rates. And this pattern was widely repeated throughout the American banking system. And this is the phenomenon I call the Fed as Pied Piper of interest rate risk. Our colleague Paul Kupiec has recently done a very interesting bottoms-up analysis, and Desmond mentioned his answer that if you mark all of the securities and the fixed rate loans, you have to mark the loans as well, of course, in the whole banking system. At year end, the mark-to-market loss was about $1 trillion, of course, with rates higher since year end on the 10-year. The loss is bigger, but let's just think about $1 trillion. The banking system has about $2 trillion of tangible capital. So more than $1 trillion loss is on a mark-to-market basis. The banking system has lost half its tangible capital. Now, what does this mean? One, it means the banking system is very reliant on being able to cheat savers and pay extremely low rates, which it is now doing on savings accounts. For example, according to the latest FDIC survey, the national average paid by banks is 0.45% in a 5% plus T-bill environment. So that's one thing. And the huge loss in interest rate risk, as Paul Kupiec points out, means there's 50% less real capital available to bear the coming commercial real estate losses, whatever they may be. We don't know how big. But we do know, for example, that delinquencies on floating rate office building commercial mortgage-backed securities are up to 20%, showing the effects of higher interest rates. Paul counts 2,667 banks, or 58% of all banks, that have commercial real estate exposure of more than 3 times their mark-to-market capital. Now, if we think about the whole banking system, and by the whole banking system, I mean the Fed plus the banks. If you think about that as one system, as it was intended to be, say, in the days of McAdoo, that since the Fed has lost $1 trillion on its mark-to-market, and the banks have lost $1 trillion, the whole system has lost $2 trillion, which I suppose you could count as real money. And perhaps on this basis alone, Fed Vice Chairman Michael Barr was a bit optimistic when he testified this month to the Congress that the banking system was sound and resilient and apparently in fine shape. Commercial real estate is, of course, a classic culprit in banking busts, and we'll hear a lot about that in our discussions today. It's all about, of course, the prices of lands and buildings. And every time I think about this, I think of the same question, which is how far can asset prices fall? And I always come up with the same answer, which is more than you think. And I'm sure this panel will enlighten us more on both the interest rate risk and the commercial real estate risk. Well, among other items, the Financial Stability Oversight Council, led by the Secretary of the Treasury, has just assured us that large independent mortgage banks are systemically important and a source of, as they said, which can, as they said, undermine financial stability. We might see if the panel agrees with that. My own view is that a key source of systemic risk in the American financial system is the government's constant promotion and subsidizing of real estate credit. And that is endemic everywhere in our financial system. Desmond also mentioned war. Without doubt, the most important financial events in history are big wars. And we got two pretty big and possibly escalating wars going on. We're entangled in, we, the United States, are entangled in. And we may ask, as Desmond has, what financial stability risk does that entail? Our panelists are going to give opening remarks of 12 to 15 minutes each in the order, as Desmond said, of Yan, Bill, Robin, and Desmond. And we're going to give each of them a chance in the same order to respond to each other or clarify points. After that, we'll move to a general discussion, including the questions which you can send electronically to AEI, and AEI will get to me. And we will adjourn not later than promptly at 3 o'clock, after which we will have had, I'm sure, a most interesting and instructive exchange. Jan, welcome, and you have the floor.
All right, thanks so much. Thanks for inviting me. Thanks to AEI. So I have a much more optimistic view than what was apparent in both Desmond's and Alex's opening remarks. And and it's mainly because I have a pretty optimistic view on the economic outlook, both as far as growth is concerned and as far as inflation is concerned. And I think if I'm right, then the undoubted issues in the financial system that you outlined, I think, are going to diminish over time. I don't think the negative sort of crisis-like developments that each of you were hinting at will come to pass, because growth will remain sufficiently solid and inflation will come down, and that will allow financial institutions to basically earn their way through a lot of these losses. And under my forecast for the economy, rate cuts are a lot more likely than rate hikes from here. The timing is admittedly uncertain. It is taking longer than we thought, but I think it's still highly likely that 5.25% to 5.5% for the funds rate is the peak. And if so, then the 525 basis points of rate hikes that we've seen are going to move basically further and further into the rearview mirror. We haven't seen any sort of major contagion in the economy from these big rate increases. Of course, we had the high-profile bank failures early last year, but that was over a year ago, and we've moved right through it, and I think we'll continue to move right through it. And that's sort of my broad view on the financial stability issues. I mean, financial stability issues are very, very important. Certainly, in the run-up and immediate aftermath of 2008, I was extremely worried about financial stability issues. I think right now, I wouldn't judge the financial stability risks to be anywhere near as great as they were in that period. And with that, I'd like to just summarize my outlook and our outlook at Goldman Sachs for for the economy. And let me just try to share my screen. Sorry, where I am. Where am I? Pardon me, one sec. I'm having some trouble here. Okay, here we go. Sec. All right. So, here where we expect the global economy to grow. U.S. growth, we're at 2.8% for 2024, 2.2% for 2025. Nowhere close, of course, to a recession, and at least a few tenths, half a percentage point or so above the consensus. That has been our view for the past couple of years, generally an above consensus view with at least reasonably solid growth. Markets have generally moved in that direction as well. Consensus forecast has moved higher for 2024. And we think there is upside potential for 2025 as well. I think there are two significant areas of support from the demand side that are helping the U.S. continue to grow at a solid pace. Number one, a significant increase in real disposable personal income growth, in part driven by real wage growth, with inflation down from 9% to 3%, if you look at it on a headline CPI basis, and wage growth diminishing more slowly, coming down, but coming down more gradually, so that is supporting household income growth. Second driver is really the improvement in financial conditions. We had a large drag on growth from the 525 basis points of rate hikes in 2022 in particular. We like to look at this through the lens of our financial conditions index, which is a weighted average of the federal funds rate, the 10-year treasury yield, credit spreads, equity prices, and the trade-weighted dollar, with weights that mirror the impact of shocks to each of these variables on GDP growth over the subsequent year. We saw a very large tightening in financial conditions from late 2021 to the third quarter of 2022, really driven by the Federal Reserve. That subtracted up to 2 percentage points from growth in late 22, early 23, but with financial conditions more stable, a little bit easier, in fact, since then, this has turned into a more neutral or slightly positive factor. We, at current levels of financial conditions, we expect this to continue and expect a, I'm sorry, I accidentally turned off my video. We expect a modest positive impulse. Now, with that strong growth, why are we also optimistic on inflation? Basically, the reason is that the supply side has grown at a healthy pace as well. And demand has been supported by real income and financial conditions. Supply has been supported by reasonable productivity growth at or slightly above the 1.5% trend of the pre-pandemic period, as well as strong growth in labor supply. And the early part of the post-pandemic period was basically marked by a big increase in labor force participation from extremely depressed levels back to more normal levels. That probably came to an end about a year ago, but then in the last year, we've had a large influx of immigrants, in particular unauthorized immigrants. We're estimating total immigration in 2023 at 2.5 million, about 2.5 times as much as on average over the prior couple of decades. And that has basically allowed GDP to grow at a rapid pace, payrolls to grow at a rapid pace, without a tightening of overall utilization of labor. And you can see that by looking at measures of the supply and demand of labor, tightness, overall tightness of the labor market. The left-hand side shows a range of indicators of labor market tightness, which were at unprecedented levels in early 2022, but have generally moved back to approximately 2019 or early 2020 levels since then. You can also see on the right-hand side that the US, if you look at it internationally, has seen a similar rebalancing or maybe even a slightly greater rebalancing in the labor market than other advanced economies. The right-hand side looks at what we've called the jobs workers gap, the difference between job openings and unemployed workers. Again, very, very overheated in early 2022, but now back to levels that are more similar to the pre-pandemic levels. And this is being confirmed by what we see on wage growth, nominal wage growth. It's coming down gradually, as I said earlier, but it is coming down, and that's visible across a broad range of indicators. Left-hand side here shows our wage tracker, which uses the employment cost index, average hourly earnings, and the Atlanta Fed wage tracker, and a couple other measures. The right-hand side focuses more on leading indicators of wage growth, including business surveys and wage increases in job ads, and this points to further deceleration. And this is why our view is that the already dramatic disinflation that we've seen since 2022 has further to go, despite the upside surprises of the first quarter of 2024. And we're looking for both core and headline PCE inflation to return to 2% in 2025. In our view, the upside surprises of the first quarter were largely indicative of lagged catch-up inflation in a few specific areas. Housing is an important one, where the official rent and owner's equivalent rent indices lagged behind reality significantly. But we also saw catch-up price increases in areas like healthcare, as well as a number of regulated prices. And we expect that to diminish as we go forward. Looking for continued low inflation in the goods sector. We think there's still room in some parts of the goods sector for prices to fall outright, for example, in used cars. In other areas, we think we'll see low positive inflation rates, and that nets out to slight negative numbers for core goods PCE inflation overall. On the housing side, as I said, the official indicators are badly lagging relative to rents on new leases, and I would say with a reasonable degree of confidence, at least relative to other types of forecasts, I expect further deceleration in the in these official measures of rent inflation, which, as you know, are very important for CPI inflation and PCE inflation. And lastly, I'd say I'm heartened by the fact that inflation expectations have been very, very stable and anchored as far as long-term expectations are concerned throughout this entire episode, and that the increase in shorter-term expectations has now largely unwound. We're effectively back to where we were on average in the prior couple of decades, and that is increasing my confidence that the Fed is going to be able to get us back down to 2% without without having to see significant weakness in economic activity. Now, what that will involve in terms of interest rates, I think that is much harder to know. Our baseline expectation is that we'll see a couple of cuts in 2024. We have certainly pulled back on that in the course of the year in response to the upside inflation surprises, but baseline would still be gradual rate cuts that take us back down to the mid threes on the funds rate by early 2026. But I would acknowledge that there's a pretty broad range of possible outcomes around that. I could imagine certainly a weaker economic environment. We have said risk of recession over the next 12 months is 15%. So if I lengthen the horizon to early 2026, that would give you something like 25% probability of a recession. In that case, of course, we would likely see much more aggressive rate cuts. But I could also imagine an environment in which we find that inflation is stickier. Things keep happening that prevent the Fed from cutting this year. And then you get into 2025. Maybe there are new risks to price stability on the horizon, such as an increase in the trade war, and that keeps the funds rate higher for longer. I think if I look at the scenarios around that baseline view, right now these risks are reasonably evenly distributed, but the range of possible outcomes is certainly significant. I will pause here in the interest of time, and thank you very much.
Thank you very much. Basically, we hope you're right. And let's go ahead to Bill.
I hope I'm right.
Bill, you're on mute.
Okay, here we go. All right, so thank you, Alex. Thank you, Desmond. And let me extend my thanks to AEI for the invitation to be on this panel. I'd actually like to start by recognizing all the work the Federal Reserve does on financial stability issues. The staff and leadership of the Division of Financial Stability are incredibly talented and hardworking, and the financial stability reports they produce are excellent. The division, with input from around the Federal Reserve System, produces quarterly reports, briefs the board, and then briefs the FOMC. Two of those reports become the financial stability reports released to the Republic. And the minutes of FOMC meetings that do not include projections, so not the minutes being released right now, include a summary of the most recent internal report. Moreover, in the end, there's really only one thing a central bank can do in response to a financial crisis, and that is to lend or spend money. And the Fed exercised its lending powers and its ability to purchase assets quickly, creatively, and forcefully in response to the COVID crisis and the bank failures in spring 2023. While I don't agree with every choice, I am grateful for the public service of those involved who worked tirelessly for months on end. So in my remarks, I will discuss three things: the Fed's role in the bank panic in spring 2023, the dim prospects for dynamic macroprudential supervision, and my current financial stability concerns. So the bank failures in the spring of 2023, we need a shorter term for that episode, by the way, were first and foremost a failure of bank management. Managing interest rate and funding risks are banking 101, and the bank's management got Fs. They were also a failure of bank supervision, including supervision by the examiners from the San Francisco Fed and by the Fed officials in Washington responsible for directing and overseeing the supervisors in San Francisco. It's noteworthy that in the head of supervision at the San Francisco Fed's last communication to banks before the failures, he emphasized climate risk and the importance of fair lending, but did not mention interest rate risk or risks from uninsured deposits. The FOMC also bears some responsibility. A central bank that gets behind the curve on inflation, as the Fed did, still has to raise rates, but just by more and more quickly, and that tends to break things. Furthermore, in spring 2022, the committee was telling people that it was only going to raise rates to 2.5%, which it described as neutral, at a time when inflation was running at 6%, which is crazy. But the market believed them. As a result, the move in longer-term rates was historically sharp when investors realized by how much the Fed needed to tighten, adding further to market turmoil. Relatedly, the Fed's view that inflation was going to be transitory may have made it unable to ask banks to prepare for a sharp rise in rates. The Fed also fell down on its responsibility to ensure that banks can access the discount window and have enough collateral pledged to meet a run on their deposits. Before the global financial crisis, examiners judged a bank to be liquid if it had diversified, reliable, regular, and contingency funding, including the capacity to borrow from the discount window. After the global financial crisis, liquidity regulations are about ensuring banks have large stockpiles of liquid assets and discouraging banks from using the discount window. 2 weeks before SVB failed, I wrote a note arguing that that shift was a mistake and calling for a comprehensive review of liquidity requirements. In the event, SVB failed awash in liquid assets, but with concentrated, unreliable funding and unable to borrow from the discount window. The post-crisis regulatory reforms were intended to ensure that a bank like SVB could fail safely. Viewed from the outside, it appeared that on SVB weekend, the Fed looked around at the other banks at risk of a run and realized that they were also insufficiently prepared to borrow from the window, raising the possibility of a widespread bank panic. As a result, the Treasury, FDIC, and Fed invoked the systemic risk exception to least cost resolution, allowing the FDIC to bail out uninsured depositors. If banks had been prepared to meet a run by borrowing from the discount window, we could be celebrating the safe failure of SVB rather than lamenting the failure of the post-crisis regulatory reforms. The bank failures last spring added to my skepticism that it is possible for the Fed to execute dynamic macroprudential supervision policies successfully. Macroprudential policy involves actions taken by the banking authorities to address broad risk to the financial system, as opposed to microprudential policy, which are actions taken to maintain the safety and soundness of individual banks. Macroprudential policy can be static, such as applying more stringent regulations to systemic banks, or dynamic, leaning against building financial imbalances. In the United States, the premier dynamic macroprudential policy tool is the countercyclical capital buffer, or CCYB, in addition to capital requirements that can vary between 0 and 2.5 percentage points, depending upon the state of the financial cycle. The CCYB is set by the Federal Reserve Board. Regulation Q states that the board will raise the CCYB when systemic vulnerabilities become meaningfully above normal, and reduce the CCYB when the conditions that led to its activation abate or lessen. The CCYB was created in the aftermath of the global financial crisis based on the fact that mortgage terms had deteriorated in 2006 and 2007, and raising capital requirements during those years could have lessened the severity of the crisis and possibly prevented it. But to execute such a policy, it is necessary for the macroprudential policymaker to see the crisis coming. I'm no longer confident that such foresight is sufficiently possible to warrant giving the Fed the mandate of managing the financial cycle. While it was widely recognized that mortgage terms were slackening before the global financial crisis, the Fed, myself included, did not see the financial stability risk from the unstable funding of those loans through the shadow banking system. The COVID financial crisis, easily the most severe since the global financial crisis, illustrated that some crises are completely unforecastable. The bank crisis in the spring of 2023 was the event that changed my mind about the feasibility of dynamic macroprudential supervision. The conditions that gave rise to the bank troubles are textbook examples of tinder for a financial crisis. SVB was funding investments with long-term risky assets, investments in long-term risky assets with short-term cash-like unreliable funding. Its failure sparked a classic bank run that brought down Signature Bank and First Republic. But none of the financial stability monitors in the government, including the Federal Reserve, saw the trouble brewing. The Fed's policies towards leveraged lending in the mid-2010s was another example of how difficult it is to be a macroprudential supervisor. The issue was whether risky loans originated by banks for sale to non-banks were a financial stability risk. FOMC transcripts reveal that Dan Tarullo, the governor over supervision, and Nellie Lang, the director of the Financial Stability Division, correctly concluded that the loans were not a financial stability risk because they were stably funded, a conclusion later confirmed by the GAO. But Chair Yellen was in a battle to keep monetary policy highly stimulative, and several FOMC participants were concerned that the low rates were leading to financial excesses. She insisted that banks stop making the loans so she could demonstrate that the Fed could address financial stability risks with prudential tools, not monetary policy tools. The episode further illustrates the problems of giving the Fed both monetary policy and financial stability responsibilities. Turning to my current financial stability concerns, first, I'm not particularly worried about commercial real estate. It seems highly likely that losses in the sector will rise further, but the issue is not whether there will be losses, but whether financial institutions are adequately prepared for those losses, and banks have boosted their loan loss reserves in anticipation. In general, financial stability risks arise from investments that are perceived as safe, like deposits at prime money market funds in 2007 and uninsured deposits at SVB in 2023, not investments seen as risky. That said, I recognize that insurance companies are also big investors in CRE, and I am not an expert on risks from insurance companies. I do worry about the CRE losses, and about the CRE losses and the carry costs of underwater securities depressing regional bank earnings, one of the most important market implications that regulators seem to be collectively ignoring. More importantly, the tightening of regulations on regional banks that seems in train, combined with the government's antipathy towards bank mergers, has put the regional bank model under threat. Government policies seem to be pushing us toward a barbell banking system with thousands of community banks and a few large international banks. While not obviously a financial stability risk, regional banks are important lenders to small and medium-sized businesses, so their loss would reduce the growth and vitality of our economy. I'm also concerned that everyone, including the Fed, is talking about the possibility that interest rates could go down or could stay where they are, but very few people are discussing the possibility that the Fed will need to tighten further. While down or unchanged are the most likely outcomes, I agree with Yan on that. If inflation remains stuck where it is and economic growth remains strong, and if the neutral federal funds rate has risen, interest rates may need to go higher to slow the economy and bring inflation down. Lastly, the massive and rising federal debt is an existential risk to the financial system in the country. The Fed's contribution to the risk comes largely through the supplementary leverage ratio requirement. The SLR requires banks to hold the same amount of capital for all activities regardless of risk. When the Fed calibrated the SLR, it expected reserve balances to return to $25 billion, and therefore the regulation not to bind. Now reserves are $3 trillion, and that vast quantity of riskless assets that the banking system must hold makes the leverage ratio much more binding. Consequently, treasury market intermediation has become more expensive, and the capacity of primary dealers to intermediate has remained stagnant over the past decade, while the treasury debt has exploded. As a result, the treasury market is unable to handle flows that occur under stress, and the Fed has had to become the buyer of last resort. In conclusion, several years ago, I wrote an op-ed titled, "I Don't Know Why She Swallowed the Fly," after the nursery rhyme about the woman who swallowed a fly, then a mouse to catch the fly, a cat to catch the mouse, and so on. My point was that the Fed keeps causing problems with its actions, such as injecting so much liquidity that the interbank market has withered, and establishing regulatory requirements that are hostile to capital markets intermediation, that it then always solves by becoming ever larger and more involved in the financial system. In a recent paper, I described how the Fed got so huge and why and how it can get smaller. It's time the Fed followed the Bank of England, the ECB, the Bank of Canada, and the Reserve Bank of Australia and begin a journey back to a de minimis presence in the financial system in normal times. Thank you.
Thank you, Bill. I certainly share your dim outlook on the prospects for macro-prudential regulation as you so clearly discussed. Thanks very much. Robin.
Thank you. Thanks, Alex, for moderating, and Desmond for inviting me. And of course, hats off to AEI for putting together such a great group of people. So the way that I would summarize the discussion so far, Yan gave a very nice overview of the conjunctural picture, which is positive and which I share. Bill sort of talked about the difficulty of ex ante identifying as policymakers financial stability risks. And I think SVB and all the ructions that followed are a great reminder. And so my initial set of remarks are basically going to sit between those two views. And in particular, it has become pretty obvious on a number of dimensions, and this goes beyond the United States, that we are suppressing volatility in markets through intervention. And of course, that has many ramifications over time. It creates moral hazard and can cause ultimately volatility to rise in explosive fashion when our interventions stop. I will also add an international dimension to what Yan and Bill said when we talk about the risks to the outlook going forward. So I've just shared my slides. We are on a number of dimensions suppressing financial market volatility. You can give a number of examples. This is by far not an exhaustive list, but we obviously have in Japan, Desmond, you mentioned this just before we went live. We had for a very long time yield curve control in Japan from the BOJ. That's a yield cap. It is volatility suppression, basically. We at the ECB in Europe have something less extreme, but we have de facto caps from periodic intervention. We have emergency bailouts. Bill did a great summary of those. And I would add, we have emergency bailouts, not just of SVB and the other institutions that failed, but we've had an increasing number of bailouts in government bond markets also, which of course has lots of knock-on effects for the rest of financial markets. Remember that in a period from March, April, May, the Fed bought around 1.2 trillion in treasuries to get the US Treasury market back under control because of the highly leveraged basis trade, which is basically just a fancy name for a carry trade that hedge funds are doing. When we do these bailouts, it encourages risk-taking. We are truncating the distribution of risks that exists in asset markets. And of course, that has consequences. Another volatility suppression that we are doing is on debt issuance. One of the things that's been fascinating is that debt issuance in the United States has shifted to very short tenors to try and prevent long-term yields from rising. So Yan talked about financial conditions. That obviously has an impact. So the question really, when you zoom out, is, are we balancing correctly our inability to forecast financial sector instability so events like SVB, with the salutary effects from a blowup? Or are we intervening too much and therefore encouraging unnecessary risk taking? And I really worry that we're doing the latter. We're intervening far too much. How did we end up here with all this intervention? I think it goes back to QE. The chart on the right shows you central bank balance sheets. What was supposed to be a cyclical tool at the zero lower bound has turned out to be anything but cyclical, because of course central bank balance sheets never unwind the holdings that they build up of government bonds. They only ever rise with very few exceptions. And that accumulation and bond holdings is kind of transmogrified into all kinds of management of volatility across markets. I'm going to talk about three risks: inflation, which I think is a positive risk. I think inflation will come down faster than expected. But then I'll talk about geopolitics. Sanctions are a disaster. I really worry about that encouraging autocrats to do bad things. And I'll talk about the US election, which I think is another big risk. Central bank yield cap. So Desmond, this slide is dedicated to you. It shows you in the left chart the BOJ. This is from Japan's flow of funds. The black line is net new debt issuance by the Japanese sovereign of coupon securities, so longer term JGB government bonds in Japan. And the blue bars show you what the BOJ is buying on a net basis. And you can see that the BOJ is absorbing 100% of net new issuance. So there really is, and this goes to Bill's point just now, there is no market price of Japanese government bonds. It is a market where private market makers have basically been completely crowded out. There's very little liquidity. The price is something that is being set by an interaction between the BOJ and the Ministry of Finance, and it is in a way a pretend market. So the rise that we've now seen in 10-year JGB yield is very much a government engineered move. It is a direct reaction to recent yen weakness. You will note, Desmond, to your point just before we went live, the yen is still very weak. To stabilize the yen in any material fashion, you need JGB yield to go significantly higher. Japan can't afford that, so they're really in a very difficult situation. This is, again, about suppressing volatility. You can suppress volatility in the JGB market, which Japan has done with yield curve control, but then you get volatility in the currency market, and they don't want that either. So they're pivoting between these different things. The right chart shows you intervention that the ECB has done to cap yields. The ECB is not anywhere near what the BOJ is doing in terms of managing yields, but it has periodically intervened very heavily to cap Italian yields. In particular, mid-2022, Draghi's coalition government collapsed. It was during the peak of the 2022 inflation scare. And basically what the ECB did was to allow German government bonds to roll off very significantly, and it used the proceeds to buy Italian government debt and Spanish government debt. These are yield caps. It is government. It is basically a government bond market manipulation to avoid volatility and instability. The emergency bailouts that we've talked about, I will not say too much about them because I think Bill gave a phenomenal summary. I would only add, we have a growing list of government bond market blowups. So we had the US in March 2020. We had the Eurozone mid-2022. That is the example that I just talked about for the ECB. And then, of course, we had the LDI blow up in the UK in September 2022. These are all symptoms of what Bill was talking about in terms of rising R-star, rising global interest rates, which make maintaining and servicing high debt burdens increasingly cumbersome, and they make leveraged carry trades riskier. The question about whether the SVB bailout was justified, I think, is a very tricky one, and I am not sure that SVB was systemic. The two charts below show you cumulative deposit growth in event time through the course of the year. You can see that cumulative deposit growth in 2022 went negative in the course of the year. That had nothing to do with banking distress. This was central bank hikes from the Fed. You had a move from deposits into money market funds. This was not about banking distress. And I think generally this weakness in deposit growth has been overinterpreted. Cumulative loan growth through the course of 2022 and 23 was fairly stable and positive. Again, I worry that, you know, this little volatility, is this the right policy choice? This little fallout for deposits, this little fallout for loan growth, I really worry that we are intervening too much. Debt issuance. I don't think I need to remind anyone, Bill did a great job of this, of the very large fiscal deficits that the United States is running. What has gone a bit under the radar is the financing of these deficits. The left chart shows you the breakout of funding, where the blue bars show you issuance of long-term government debt. So these are coupon securities, and issuance of short-term bills. It is normal for the United States to ramp up issuance of bills during a financial crisis. When there are unusual events hitting the yield curve, you don't want to stress the long end of the yield curve, you issue short. Fine. But we are nowhere near a crisis right now. We are anything but. Growth is solid. Yan gave a great summary. And yet, in 2023, 80% of our issuance was in bills. You will remember that periodically in the course of last year, long-term yields were rising. This short-term issuance is a direct response to that, and basically is the Treasury trying to manage financial conditions. And again, it is volatility suppression. It is something that, should policymakers be doing this? I am not sure. I'm now going to talk about inflation risk as the first risk going forward. COVID completely screwed up our seasonal adjustment. Yan alluded to this in his comments. You will know from Econ 101, menu costs. It's painful to adjust prices. It's costly for businesses. It has always been the case that at the beginning of the calendar year, companies, businesses, especially small businesses, adjust prices upward. With high inflation, these start of year price resets have been much higher than normal. It has thrown for a loop our seasonal adjustment mechanism. So what I'm showing you here on the left is seasonally adjusted data for core PCE in the United States. And you can see in 2023, and again now, that the seasonally adjusted data are unusually high in the first part of the year. And that is basically, we are not able, given our seasonal factors, which are conditioned on many years of low inflation, to filter out these start of year effects that are happening. You will see in the course of 2023, after very high inflation early on, which scared lots of people, inflation subsided and was very well behaved. So I'm definitely in the camp that inflation will fall quite significantly in the course of this year. Europe has this going on, and then some. You will see that these start of year effects in the Eurozone are even more pronounced. So I think inflation actually is a positive for financial stability risk. I agree that the Fed will be able to roll back hikes quite significantly on the basis of well-behaved inflation. Where I'm much more worried is sanctions. Sanctions on Russia are most importantly a deterrent to other bad actors. And obviously we have China, fear around Taiwan in particular. These charts are a database that I built over time of oil tankers leaving Russia. And you will note that the vast majority of oil tankers are owned by an EU country, Greece, that's the blue bars. And this was an amazing opportunity for Europe in particular to control Putin and to dictate the price of oil that he gets. Did the EU do this? Did the West take advantage of this unbelievable opportunity? It did not. In fact, it did the opposite. Greek ship owners have been busy selling their oil tankers to what is called the shadow fleet. So you will see in the right chart, the Baltic, which is the main exit point for Russian oil. The blue bars go down almost to zero, and the gray bars, which are the shadow fleet, have been rising. This is a transaction that never should have been allowed. It fundamentally undercuts the credibility of sanctions, and it basically says to someone like Putin or China's Xi, the West is more interested in making money than enforcing geopolitical sanctions. Same thing with exports from Germany. They've been going crazy to a out-of-the-way place like Kyrgyzstan. Kyrgyzstan is not known to be a logistics hub of transportation. Exports of cars and car parts from Germany to Kyrgyzstan are up 5,000%. They are crazy numbers. Obviously, all these cars are not servicing domestic demand in Bishkek. They are going to Russia. Again, this severely undercuts the credibility of sanctions, and it threatens the deterrence effect. Last thing I'll talk about is the US election. If Trump wins, I think we may get some serious out of consensus market price action, and a lot of that hinges on tariffs. We learned in 2017 and 2018 that markets trade a tariff. So in this case, tariffs that were imposed in 2017 and 2018 on China, they trade those as a negative terms of trade shock, which means the dollar goes up and China, which was hit by tariffs, the RMB goes down. So you may have, in the event of a Trump win and tariffs on China, action against Mexico, reduced support for Ukraine, which would hit Europe. You may have a lot of dollar strength and a completely out of consensus rise in the dollar. Remember that the RMB alone in 2017, 2018 rose 10%. 2018 was a period when emerging markets fell out of bed. We had an emerging market crisis led by Turkey and Argentina.
You're up against your time here.
Sorry. So I'm finishing up.
Wrap up.
So we may have a lot of financial stability risk around the US election in the event of a Trump win. Thanks. Sorry.
Thank you. Highly interesting. The only thing I'd add is that the SVB bailout, when it was really a systemic bailout, because they convinced depositors all over the country in any bank that unsecured depositors were going to be paid off. And then the Fed made under margins, which were in fact unsecured loans to a lot of banks. So you had a systemic bailout going on there. Anyway, Desmond, we have reached you. You got to unmute yourself.
That's a good idea. I'd love to share the optimism of the previous panelists, but when I look at the numbers, I find it really very difficult to do. And in fact, I've got to say that this reminds me, Alex and I did a seminar March 2008, just when the subprime problem was breaking. We were assured that everything was just fine, that everything could be well managed. Don't worry about it. It's all going to work out. And we all know what happened. I'm not suggesting that we are heading for another 2008, 2009 crisis, but I am suggesting that it would be very surprising, at least to me, if we get through this without a financial crisis of one sort. Maybe it's the savings and loan of the 1980s or a long-term capital management, something of that sort. And what I'll do is I'll try to substantiate my view with a bunch of slides. So let me just pull up the slides. And what I basically saying is that there are three things that really give me pause about whether or not we get through this, without some sort of financial crisis. The first is that we've swung from ridiculously easy monetary policy to a rather strict monetary policy. This is a rather abrupt change. Normally when you do something of this, things break. The second point I'd make is that this all is occurring in the context of, what I'd say is a slow-moving train wreck in commercial real estate, of a big proportion. We're talking about big numbers here. And the third thing is, what Alex alluded to, is that the interest rate hikes have done real damage to the banks' balance sheets in general and the regional banks in particular. So let me go through each of those points. The first, the swing between a decade of real monetary policy ease to one of tightness. If you just look at this chart, basically what this chart is telling you, this is the interest rates of the Fed. We had a period, 10 years, of interest rates at zero, more or less. They bounce up a little bit at one stage, but basically zero interest rates. This is something we haven't had before. To add to that, we had the Fed increasing its balance sheet by, a mere $8 trillion for a period of time. It took them 100 years to get to 800 billion, but we got to $8-9 trillion by the Fed engaging in quantitative easing, flooding the market with liquidity, causing all sorts of distortions in pricing. And then what we've done is, just in terms of the money supply, I find this chart really alarming. We had an increase in the money supply in 2021 and so I say between the beginning of 2020 and the end of 2021, broad money increased by a mere 40%, only to contract subsequently. So, this causes a lot of distortions, that'll come home to haunt us. What I said is the Fed slams on the monetary policy brakes really hard. This chart just shows the black line is the latest cycle, the one that began in March 2022. We ran up 5.25 percentage points, in something like 18 months, which hadn't occurred before. You've got to go to Volcker, that period. But if you exclude that period, we haven't seen nothing like that. And as I mentioned, the Fed has reduced its balance sheet by $1 trillion and allowed the money supply to contract. We haven't had a money supply contraction in the past, since records have been made since 1959. So let me go to what I'm calling a slow motion commercial real estate train wreck. And I think that it's important to look at the dimensions. The numbers are, as I say, pretty big. This chart just shows offices, its main cities remain half empty. If you look at vacancy rates, we ran about 20% on vacancy rates, but you see that there's no recovery. Basically, things just collapsed during the pandemic. They bounced a little bit up, but they're pretty low, and they're likely to remain so for a period of time. And that, of course, puts downward pressure on prices. That if we look at this chart from Green Street, just shows in big cities, San Francisco, Los Angeles, New York, Seattle, Miami, all of these have price declines on office space of something like 50%, The rest of the world's not doing too well either, but it's half the decline. I don't know whether we get commercial real estate problems elsewhere, but we've certainly got them in spades in the United States. And it looks like we're just at the beginning of the price discovery process. What is not too encouraging is there's a huge amount of loans that have to get rolled over this year. We're talking about $900 billion of loans that are going to have to get rolled over. I don't know how this happens, if the interest rates at which they've got to get rolled over are at least 5 percentage points higher than the ones at which they were contracted. And on top of that, we've got the prices declining. So, I just expect that this chart, which shows the default rate on office, is really climbing. So all in all, this isn't too happy a picture for the banks in general, but the regional banks might be a particular problem because they're holding something like 20% of their portfolio is in commercial real estate. So what I want to get to is what Alex referred to, this chart from the FDIC, shows the losses, at the end of 2023, they were something like $700 billion, but interest rates have gone up. So, the number of around about $1 trillion in mark-to-market losses on the bank's balance sheet aren't good. So here we've got a situation where the mark-to-market losses are pretty high, and they just about to get hit by commercial real estate. And I'm not talking about credit card loans and auto loans and all the other loans, where there are defaults. I think that you've really got to see this as a big picture kind of thing. You've got to look at if you're looking at the balance sheet, look at the whole balance sheet. And, it kind of surprises me that we're not in a recession and you're just seeing auto loan defaults and credit card defaults going up. So I think the banks are in, it would be an understatement to say that they're in a little bit of trouble. And here they're bleeding deposits. So I don't see how we don't get a whole string of bank failures the next year or two. And I don't see how that doesn't produce a crisis. Let me end with the last chart, which is, from our AEI colleague, Paul Kupiec. What he's done, I think, is great work. That what he's done is he's basically married the loan losses, the mark-to-market losses, together with the commercial real estate story. And, what he's doing is he's comparing the exposure, what he calls the concentration ratio. He's looking at the commercial real estate loans as a proportion of the equity that the banks have got, the capital that they've got. Now, the blue lines are if you don't mark to market, and that's, that is what the Fed is looking at, perhaps. And, that's a happy picture, that above 3 is they regard as rather risky. But you find that most banks, and, particularly when you look at it, consider this in terms of the size of the banks, that's a very reassuring picture. But if you look at the actual balance sheet, if you market to market, you've got just like 400 banks that have got concentration ratios that are over 12. 3 is when you get worried, but these are at 12. So it doesn't surprise me that you're getting studies saying that at least 400 banks, there's an NBR study at the end of the year saying that 400 small to medium-sized banks are going to fail. And we know that that is often not the case. So in short, I would love to believe the previous panelists that all of this is going to work out just fine. But I've seen too many crises to know that this is probably a long shot. So I'll leave it at that, Alex.
Thank you, Desmond. I think looking over the whole panel, we had a lot of very interesting and insightful views. Maybe we could get your, unless we want to keep looking at this chart here. Maybe we could get us back for discussion.
But I think that this is the chart that concentrates the mind. Never mind.
Oh, look at this. It does. The view of the chart that concentrates the mind. I think that's Dr. Johnson, isn't it? Anyway, I want to give the panelists a chance after a lot of material being presented, a lot of really interesting thoughts, to go back through the panel and take about 2 minutes or 3 minutes maximum, either to react to anything anybody else said, or to add thoughts of your own or expand on them, and just in the order we went. So Yan, any comments?
I don't really have anything in addition. I guess, unfortunately, I wasn't there at the March 2008 panel. I do think this is we're in a very, very different environment here from March 2008. The banking system is much better capitalized. We didn't have a massive house price bubble. I mean, there were plenty of very, very serious warning signs in the run-up to 2008, which we were certainly very concerned about at the time, and sort of got concerned about in kind of 2005, 2006, and really throughout that period. I think this is a very different environment. And I also think, a year ago, a lot of this would have been, I think, to me, a higher risk. I mean, if I look at the risk of recession that we have assigned over the next 12 months, a year ago, we were at 35%, approximately. So didn't expect a recession, but were certainly concerned that the risks were higher than normal. And a lot of that was because we had just seen some significant bank failures, and there clearly was, a possible path, a plausible path, maybe even, in which this could really spiral. I think a year on, I can't rule it out, obviously. This is all very hard to forecast. But I just think if we were going to see it, chances are we would have seen something much worse already. And in the meantime, we've made a significant amount of progress in terms of rebalancing the real economy, rebalancing the labor market, bringing inflation down. So all of that, to me, says that the risks are now quite a bit lower.
Thank you. Bill, 2 or 3 minutes, comments?
Certainly. All of you, those were all extremely interesting presentations, and I thank you all. I learned a lot. I share Jan's view that in terms of the banking situation, this was over a year ago. The situation seems to have stabilized. Desmond, your graph seemed a little bit out of date to me. It looked like your deposit outflows were really in 2023. As we were just preparing for this round of remarks, I just called up, a graph of bank deposits from Fred. And if I can figure out how to share my screen, here we go. I'll call that up. Is that being shared? Share. Here we go. This is the decline that occurred. This is the decline that, of course, occurred because the Fed was raising rates and deposits were moving. Depositors, not being depositors, many of them were moving to pursue higher rates out of the banking system. This is the decline that occurred during the banking turmoil. But as you can see, the situation has stabilized, and indeed deposits have come back up. These are other deposits, so it excludes large time deposits. And apologies for not being able to show regional bank deposits, but I don't have that handy. I worry more about the possibility of the risks posed by the gigantic federal debt and the inability of the Treasury market to handle those swings. But nevertheless, I mentioned that. So I am curious what what risks Jan and Robin see, what risks they are concerned about. I'm curious what Jan's outlook for the balance sheet is, for example, and I'll leave it there.
Thanks, Bill. Thanks for the chart. It does emphasize in my mind the remarkable ability of the banking system to cheat the savers and keep
So you said that before, Alex, and I thought the American Enterprise Institute was a fan of capitalism. There's thousands and thousands of banks. You cited savings accounts. Everybody can move their money wherever they want. It's an extremely competitive account.
Yeah.
But I wasn't expecting to be in getting the industry attacked for making profits. But it's interesting to know.
It's only an observation. Seems to me accurate. Anyway, let's go to Robin. 2 or 3 minutes, Robin, reactions to what's been said.
So I want to come back to 2 things. First of all, a central banker said to me at a recent meeting, the expectation, the demands on policymakers have risen. And I think that's really important because between what Jan said and Desmond and Bill, the demand for policymakers to do bailouts in whatever form, and I think Bill is right to point to government debt as the principal difference from the global financial crisis to now. Debt levels are much higher. Central bank holdings of government debt are much higher. That is really the nexus that is the most important one. And that is where we are seeing the most active level of intervention. Just imagine whether the kind of quantitative tightening that the Fed has done and a few other central banks, just imagine the BOJ doing that or the ECB. Unthinkable. It would be causing huge amounts of volatility, and we basically have a policy choice to reduce volatility and to warehouse this debt on central bank balance sheet as a result. This is a value judgment. It is not clear at all that that is optimal. It means that debt reduction, which is sorely needed in lots of places, is not happening because the incentives are not there. The other thing that I would point to is the parallel between our approach to risk and debt and the way that we have been implementing sanctions. Europe is a great example of this. You have from the EU 13 sanctions packages, yet the reality is a complete disaster. This is what you call kicking the can. You say you're doing something, but you're really not doing it. And the parallel to what is going on with debt is very similar. In Europe, you have the European Commission certify that debt is sustainable, but then in every bad shock, you have the ECB having to intervene because otherwise yields would go sky high and you would have a debt sustainability issue. So there are lots of parallels from the geopolitics to debt and vice versa. Thanks.
Thank you. And the debt being warehoused in the central bank, in this country anyway, also well, in many countries, the risk and the losses are also being housed in the central banks as well, and therefore into the consolidated government books. And I don't know that we've really figured out what all that means, but it's certainly the case that in the Fed's case, $1 trillion, as I mentioned. Let me go ahead and ask a couple questions. I have
Alex,
yeah.
You forget me.
Give Desmond a chance.
I'm sorry, Desmond. How could I forget you? Desmond. Desmond, in exchange, you can have 4 minutes.
Right. Well, let me just say that the reason that I mentioned the March 2008 is that I think that at that stage, we did already have Bear Stearns ready in trouble. We already knew that there was a problem in the housing market. I just see a parallel that here we've already had signs. You had the second and third largest bank failures last year, which is telling you that there's something going on, and you've got all the trouble in the commercial bank. So that I wasn't wanting to draw more of a parallel than that. I'm just saying that you've got warning signs and you've got troubles that you can see, and you've got the Fed holding interest rates. But let me ask Yan, if he can elaborate a bit on the risks to his forecast. That I'm not sure how I see how you can be confident that we're not going to have a recession when you look at all of the external risks that are going on. China, we've got a housing and credit bubble of massive proportions that has burst. That economy is in trouble. We've got trade that is now becoming a big issue. We could be having a trade war between China. It looks like Trump and Biden are engaging in a competition to see who can be more protectionist. That can be disruptive. We've got the Italian situation, which doesn't look too good. The IMF has just come out about a report saying that that country's got debt that is unsustainable. And then we've got a mere 2 wars going on, that could get out of control. So when I look at all of this, I think that we really need to have humility when making forecasts. I'm not sure that we don't get a recession. And if you get a recession, then the kind of things that I'm pointing out will become a really big deal. Let me just raise 2 questions to Bill that, I agree with you that I think that the financial stability reports that the Fed puts out are really very good. But what kind of bothers me is that the FOMC doesn't seem to be paying too much attention to those reports. They happily keep interest rates rising, or they keep them high, that they don't. What I notice at the FOMC meetings is you don't hear anything about financial stability risk or commercial real estate problems, at least in the press conferences or in their statements. And I think that there seems to me to be a total disconnect between what the financial stability reports of the Fed and the IMF are saying and what the policymakers are doing. They just seem to be looking at they seem to be running this thing like a hedge fund. Each little move in the inflation rate is whether we tighten policy, whether we loosen policy, but they're really don't seem to be giving sufficient attention to the financial stability risk. The last thing I would say is that in terms of the Fed, what it can do, I agree with you that this prudential management is not a good idea, but what is a good idea is not to get monetary policy so wrong as they got it. Don't increase the money supply by 40% and flood it with stuff, and then get surprised that when you slam on the brakes, you get problems. That to me, that maybe it's the same point I'm making, that the Fed doesn't seem to take too much attention between the long run damage they do to the financial system by trying to stabilize the economy in the short run. That's somebody else's problem. It'll occur on somebody else's watch. But that it seems to me where the Fed is, in my view, if I were grading them on a curve, I might give them a C.
Thank you, Desmond. Any other comments from any members of the panel on what we've talked about so far? You want to expand
just on the
that?
risks? I mean, the world's an uncertain place for sure, which is why I totally agree with the idea that we need to be humble. There are risks. My estimate, and this is a judgmental estimate, is that the probability that these risks that you enumerated, and undoubtedly a number of others, some of which are more unknowns, that they result in a US recession in the next 12 months, we're saying 15%. That's roughly the unconditional average probability since we've had a recession about once every 7 years. I think there would have been certainly times in the last 25 years, and I've been a forecaster for a little over 25 years, when I would have gone below 15% as a 12-month forward recession probability. I think that's unlikely in the environment we're in, basically because of a lot of these more maybe exogenous risks. I do think the economy is quite stable. I'm not convinced that the systemic risks that have accumulated in the system are anywhere near as large as some have suggested here. But I'm absolutely aware that there are a number of risks, and Robin went through some of them, and I think they're significant. Political uncertainties, which are going to result in economic policy uncertainties, and geopolitical uncertainties, I think loom quite large. I'm not convinced that the probability that results in a recession over the next 12 months should therefore be higher, but I'm certainly not thinking about lowering my number.
Thank you. Other comments?
Go ahead, Alex.
Go ahead, Bill.
Well, I was just going to say, personally, I'm not at all a fan of the Federal Reserve using its monetary policy tools to address financial stability issues. I think that that's for all the reasons that we've discussed. I think that the Fed should stay focused on its dual mandate of inflation and unemployment. It is true. I certainly am of the view that the Fed was slow to respond to the inflation that occurred, significantly slow, and that the rapid rise in rates contributed to the troubles in the banking system of the banks that failed. I have to acknowledge, though, that inflation did come back down without a significant slowing of the economy or a rise in the unemployment rate. So in some sense, those in team transitory appeared to have had it correct. And I think that that's something we need to remember. So other than starting slow, though, I think that the Fed's monetary policy was pretty well suited, pretty well done. I think that they absolutely had to respond forcefully to the rising inflation in order to maintain their credibility and prevent an increase in inflation expectations that then could have really put them in a tough spot. So I'd say monetary policy is about where it should be right now.
I want to ask a couple of questions to the panel, but let me remind those who are watching this on Zoom that if you would like to send in questions electronically, you are welcome, and we'll look forward to them. Question for anybody or whoever would like to comment. In retrospect, what do we think about Silicon Valley Bank and following actions, the bailout of the certainly well-heeled and comfortable unsecured depositors of Silicon Valley Bank, the spreading of that around the system, the Fed's making, as I said, what were under-margined or in fact unsecured loans on underwater bonds. Now it's a year ago. How would we assess the success or problems with that set of actions? Bill, I'm gonna call on you because I know you have views.
Well, I think that one of the big tragedies here is that the Fed hadn't gone out a long time ago to make sure that banks were ready to borrow from the discount window. One of the first things that I did, I was over the discount window for 15 years. And one of the very first things that I did was to say, shouldn't we be coming to views about how much collateral banks should have at the window? And this was in sort of the Greenspan era. And the view was, no, that would be doing the business of the banks. We must let them do their own business. But that view, I think, has changed now. But one of the real tragedies here is that SVB was actually interested in signing up for the standing repo facility, the Fed's 3-year-old new lending facility, about a year and a half before they failed. We now know that they were failing their internal liquidity stress tests, which are the most binding liquidity requirements for most banks, because they couldn't demonstrate that they could turn their assets into cash. And they were hoping that they could, if they signed up for the standing repo facility, that they would be able to point to that as the means that they would do so. They didn't borrow in the repo market for their business purposes, and it was expensive to sign up because you have to get access to the tri-party repo market. And what they learned was that they wouldn't get any recognition for that added liquidity in their internal liquidity stress tests, and so they didn't sign up. So we could be sitting here in a very different situation if SVB had been able to borrow from the discount window, if they'd been able to borrow from the standing repo facility, I think that they would have still failed. They were insolvent. Their capital was zero, basically on a mark-to-market basis. But nevertheless, that if that failure had been orderly, gotten to the weekend, or even if they'd used the discount window to raise liquidity rather than selling off their AFS portfolio, which is what they did the day before they were run on. This could have all worked out in a much better way, and we would not be sitting here with. And the tragedy, it really was a tragedy that the Fed found it necessary, along with the FDIC and the Treasury, to invoke the systemic risk exception. That was exactly the outcome that we were trying to avoid. Not only to invoke it, but all of the heads of those agencies to basically stand up and say, moreover, if anybody else fails, we'll invoke it again, which was kind of an end run around the Dodd-Frank restrictions on doing precisely that. But I have to respect my colleagues, my former colleagues, friends at the Fed, in making that decision to do so, because I think that they really did look around the system and realize that there were many banks that, if they'd also been run on, wouldn't have been able to meet those outflows. And at that point, you really could have a traditional old-fashioned banking panic. So it may well have been the right thing to do. Now,
you mean on a wide basis, not just a bank?
That's right. Yeah,
many banks.
Many banks. And I think that's what they were looking at. I think if it was just SVB, then they would have let it fail, honestly. In terms of the Bank Term Funding Program, as you know, it was provided at a very generous rate, so generous that banks ultimately began to borrow heavily, simply arbitraging the spread between the rate and the rate that they get on their deposits at the Fed. It was lent, the loans were only partially collateralized. So very much not in the spirit of traditional rules of lender of last resort. But they had to throw this together over the weekend, and they had to use the tools that they had to try to instill confidence in the banking system, in those other institutions. And it did seem to work. So I have a lot of misgivings about it. It would have been a better outcome all around if all of those banks had collateral pledged at the discount window to borrow under the ordinary discount facility, and that wouldn't have been necessary. But you go to the war with the army that you have, I guess, as they say.
Any other thoughts on a retrospective on that?
Yeah, Alex, surely, Bill, you'd say that there was some sort of regulatory failure that they allowed Silicon Valley Bank to get into that position, that there seems to have been inadequate supervision. How can you let a bank have a balance sheet like this? I would agree that when the crunch time came, the Fed had little choice, that you'd have had a bank panic if you didn't do what you did, but you shouldn't be in that situation to begin with. I'd also just want to say that I can see that the monetary policy tightening was the correct thing to do, that the Fed's been doing a good job. But I'd want to go back a little bit earlier. What was the Fed thinking when the Biden administration introduced the American Rescue Plan, which was $1.9 trillion budget stimulus? That's like 8% of GDP. And the Fed just sits there and keeps monetary policy the same. So I've been putting it that monetary policy was either wrong before the event or it was wrong after the event, but it couldn't be, you couldn't have the same monetary policy unchanged, when you got that kind of budget stimulus, and I think that I'm not sure that the Fed's being overly lax, overly expansive, didn't contribute to the surge in inflation. I'm a believer in what Milton Friedman said, that inflation is always and everywhere a monetary policy phenomenon, and I think that this wasn't an exception.
It's clear to me that it also contributed to the problems that the banks have in terms of their losses.
Alex, can we go back? Just be curious.
You can go anywhere you want.
I could be just curious in Robin and Jan's view on what happens if the Bank of Japan tries to normalize interest rates? Could that be a source of global financial risk, that if we get the last central bank standing, going to a more restrictive policy, what are the kind of implications that has for global financial markets?
Robin or Jan, you want to take that?
Jan, do you want to go first? I'm happy to go first if you like.
Why don't you go ahead, Robin?
Go ahead.
So, if Japan debt to GDP is 250% roughly, that is gross debt. Now there is a debate whether it is gross debt or net debt that matters. I happen to think it's gross. The interest rate now on 10-year JGB yield is around 1%. If you look at countries with far lower debt, they have interest rates between 4 and 5%. So it is clear that given the debt level, Japan has interest rates that are nowhere near where markets would set them. That is consistent with the picture that I showed, that basically there is no market price that is being set for Japanese debt, because the JGB market is basically the government selling debt and the BOJ buying it, and it is an internal transaction. If the BOJ stepped back completely from the JGB market, you would have two things happen. You would have, and I'm painting, of course, an extreme scenario. This would never happen. But just to anchor some thoughts, if the BOJ announced tomorrow, we are out of the JGB market, which of course it won't, then the JGB market would rise very, very sharply. It would probably go well above 5%.
That is to say, it would fall very sharply, as we know.
And the yen would strengthen very sharply because it is being artificially weak, because Japanese interest rates are being held artificially weak. Now, this won't happen, but we do have a natural experiment on precisely this in Europe. Christine Lagarde, the head of the ECB, the president of the ECB, sorry, in March 2020, at the height of COVID, in a press conference said, "We are not here to cap periphery spreads." This was on March 12th, 2020. And within a day, Italian spreads and Spanish spreads had widened massively. So this is the best natural experiment we have on just how big the volatility suppression is that's coming from central banks. And of course, the BOJ is at the extreme end of things. The ECB is kind of in the middle, but Desmond, I think it was you mentioned Italy and the IMF staff report, the Article 4. I mean, I think there's real volatility suppression and spread management going on here as well.
Thank you. Jan, any comments on the Japan question?
Not really. No, I mean, I think the only thing I'd say is that I would expect interest rate increases in Japan to occur very, very slowly. And that's partly, obviously wanting to avoid very rapid changes in longer term yields for financial stability reasons is part of that. But I also think that the real economy, I think, is at this point not in a place where I'm confident that we're going to be at 2% inflation in Japan over the longer term. I mean, we're above 2% at the moment if you look at it on a year-on-year basis, but if you look at sequential inflation, it looks to me like we may well be, again, below 2% for an extended period of time, in which case I think the BOJ is going to go, quite slowly. And so I certainly agree that there are, tricky issues that the BOJ is going to need to manage. And the debt stock, of course, is very, very large. And I agree that there are important risks, but yeah, my best guess is it's going to be quite glacial.
But if it's quite glacial, then that means that we're going to have continued Japanese yen weakness. And if we have continued Japanese yen weakness, when both Trump and Biden are pretty getting worked up about external competition, this could be, add to moving away from globalization.
If you get big further moves, and in a previous life, Robin was an FX strategist, a great FX strategist, and he'll have more informed views on it. I think if there is a big move, then yeah, that could certainly inflame tensions around trade. I think that's definitely true. Now the yen is already quite weak, so I think there is going to be that has to factor into your outlook on how big an additional move you're going to see. But of course, it is hard to forecast these things.
Thank you. I'm going to move to a question from the audience. It's from Matt King of Centauri Insights, who comments, there's an argument while rate policy has been tight, balance sheet policy measured by changes in reserves has been easy and correlated remarkably with the run-up in asset prices, he writes. Yet the Fed has chosen to taper QT before meeting their own estimates of when reserves might become scarce. And then he gets to a classic question in central banking. Should the Fed or should any central bank be more cautious about the risk it's contributing to asset prices and asset price run-ups? And if so, how? Any thoughts on that from anybody?
I guess in terms of what the Fed's doing on quantitative tightening is they're slowing the pace of quantitative tightening, but they're still tightening, so they're still running off, instead of running off whatever it is, 90 billion a month, they might be running off 50 billion a month, but that is still aiding the interest rate hikes. We're not in a situation yet where, if my view comes right, we'll be back in a situation where the Fed begins buying assets again, to keep the show going and to kick the can down another few years. But right now, I think that it's tightening. But I think, my overall view is that the Fed doesn't seem to pay sufficient attention to the damage it causes to financial markets by excessively pumping things up.
Certainly know that the asset prices rise when there's a giant bid in there every day, and that's I don't know whether we can get a more classic issue in central banking than that. We have another question from the audience, a completely different matter. This is from Brett Edwards. What are the implications of artificial intelligence on anything we've said? Economic growth, financial stability? Any thoughts?
Yep. I guess I was totally surprised when the IMF came out with a report, or should I say the IMF's managing director was bemoaning the fact that productivity growth was going to be low and that the world wouldn't grow very much from now to 2030. I'm not sure where on what planet she's living, with all of this technological breakthrough. It looks like technology is moving at an incredibly rapid pace. It's going to be hugely disruptive, but the one thing it's going to do is it's going to put the world economy on a very much faster growth path. This is, I would think, akin to computers coming onto the stage or the internet coming onto the stage. We're talking about very big, it's not just the OpenAI and that chat GPT, you're talking about many other robotics or 3D printing, or the whole world. We're in a new world where technology is moving really very rapidly. Whether it's a good thing or a bad thing for white collar workers, that's something else. And what sort of effect it has on financial markets, we'll see. But it looks like we're moving into a brave new world, and this is going to come sooner than we thought. I mean, I just think that, if you're telling me that in 2030, we're not going to have a productivity boost, I just don't buy that.
As part of your basic optimism, Jan?
It is, although I think it's a ways off in terms of the impact. I think over the next by 2030, I would also expect some boost from AI to growth. And we did actually lift our longer term growth forecast, US potential growth forecast, from 1.8% to 2.2% on the back of this, and made similar adjustments, though slightly smaller, in other advanced economies, and to some degree also emerging economies. It's striking if you look at the database that the US Labor Department and the European Union produce on the granular occupations in the labor market, and then the so-called ONET database that the Labor Department produces, which classifies the different occupations into different tasks. How many of those tasks can in principle be replaced by AI? Not next year, and probably not over the next 5 years, but on a 10, 15-year horizon. We came up with 25% of hours that could in principle be replaced. And once you use numbers like that, and of course the uncertainty around this is huge, but if you use numbers of that order of magnitude, it's pretty easy to add a meaningful amount to growth, even if you're conscious of all the offsets and other sort of complicating factors. So put me down in the optimistic camp on that one as well.
Thank you. I'm going to turn a little bit to the topic of our title, the Federal Reserve and financial instability. Now, the Federal Reserve part, as you know, Congressman Massey, with 20 co-sponsors, has introduced a bill to abolish the Fed. It's Ron Paul's bill, back from when you were at the Fed, bill from 1999, I think. Congressman French Hill has a bill I support very strongly, which would require the Fed to have honest accounting and actually report its net worth accurately. We could think about those too, but what Federal Reserve reforms based on all this discussion, if any, would anybody support? Or do you think the basic structure and operations are fine, or would we recommend changes? Desmond has obviously suggested behavioral policy changes. Are there structural or fundamental changes in the Fed that anyone would recommend based on all the adventures of the last 10 or 15 years?
So I would, as I mentioned in my opening remarks, I'm a very strong believer that the Fed needs to get much smaller and less involved in the financial system than it currently is. Before the global financial crisis, it was about 5% of GDP. That's what it always had been. If I remember correctly, right now it's about 26% of GDP in terms of its size. Now that's small compared to, say, the Bank of Japan, but it's nevertheless, it's vastly larger. And as a consequence, when the overnight RRP facility reached its peak, one of the Fed's, the way that the Fed has basically gotten around the Federal Reserve Act and is paying interest on the deposits of money market mutual funds, when it was at its peak, it made up, I think, about half or maybe even a little more of the assets of those money funds. And this was a facility that they intended to be a temporary facility used to help them lift off in the mid-2010s. So just as one example of the many ways that it has gone from, a very light touch on the financial system to being involved in just about everything. And that this is all, I think, largely the result of well, first of all, I will say that in my view, the big monetary policy mistake that was made over the last several years was not only continuing a very rapid QE program at the end of 2020, when the economy was clearly recovering, but then coupling that with extremely rigid forward guidance that locked it into continuing to do so for a long time. That also helped contribute to why they were late in raising rates, because they wanted to end the purchases. But it's a symptom in my mind of the move to an operating regime in which it's designed to oversupply the banking system with reserve balances, pushing money market rates down to the rate that the Fed pays on these deposits. It used to be that when the Fed, the Fed had a limit on its balance sheet. If it tried to go larger than what banks demanded in terms of the Fed liabilities, interest rates would fall. And now it's operating in a regime in which there is no natural limit on the size of that balance sheet. And I think that just leaves them more inclined to use their buying and lending capabilities to address many different problems in the marketplace. So I really think that they should be encouraged to revert to a much smaller regime. And it's heartening to see that something along those lines is happening at almost all the other Western central banks. Or at least the Bank of Japan, not the Bank of Japan, the ECB, the Bank of England, the RBA, and the Bank of Canada. Not exactly, but they're all seeking to get much smaller than they are right now. So that would be the fundamental change that I would urge.
Thank you. Any other thoughts on reforming or improving the Fed?
Yeah, Alex, maybe the problem, but it's similar to what Bill's saying, is that the Fed is very reluctant to allow recessionary conditions to take hold, so that they're too eager, to keep the system floating. They're in a very difficult position, I realize that, but the tendency is, you just keep pumping the system up, at the first sign of weakness, you just keep buying the assets, but they've got themselves now into a position that I don't see, it's easy to get out. If we do have a banking crisis, they'll come back in, and they'll buy the assets. And I think that that's true of the ECB, that basically, I'm just waiting to see what happens, with Italy, which is, totally an unsustainable situation. The markets right now, everybody's happy about it, but that's going to be tested. And when it does get tested, I'm pretty sure the ECB won't let the euro blow apart. They'll go in again and, just buy the Italian government bonds.
I would bet on that as well. I'd add one other thing to Bill's very insightful points about shrinkage. In my view, the Fed needs to return to its correct historical position, which was, we don't own mortgages. We don't go in and try to manipulate the mortgage market to advantage this sector. And their mortgage portfolio should, in my view, should be zero and should be headed rapidly in that way. And we certainly, the out of control house price inflation that we had in the second bubble, as some people say, it seems accurate, was certainly reflecting that Fed mortgage buying. Now, go ahead.
Just a last thought on the Fed. If you look forward on the Fed, the big task that they're going to have to do is somebody's going to have to buy the US government debt. Who's going to be buying that debt? We're at a situation, you just look at the CBO forecast. We're on a path. This country is running at 6.5% of GDP budget deficit at a time of cyclical strength, and it's got debt that is so high. How much longer can you expect, the Japanese and the Chinese and so on, to keep holding your debt? When they don't hold the debt, who's going to be buying it?
Good question, especially if they're deciding to buy gold instead, which they seem to be.
May I just say something on?
Yeah, I was going to call on you.
the
I was
on
going
the
to call
Fed. Can I say something positive about the Fed? I remember driving in my car in November 2020, hearing about the vaccine, and of course, it was wonderful news. But what followed was many months in which I did not get the vaccine. We had Delta, we had Omicron. This was a crazy shock. And had I been at the helm of the Fed in early 2021, I would have stuck with easy policy. And I think the Fed, in terms of its conjunctural management, has been close to exemplary. Let me give an example that's more recent. Think back to last year, inflation was running very hot. The ECB, in the early part of the year, so these were the start of year price resets that were happening. The Fed was under attack from all kinds of people that it was behind the curve. Of course, SVB happened. It probably spared us some rate hikes that perhaps would have been a mistake. But I think the Fed stuck it out and was vindicated. So in terms of the conjunctural management, I completely share Bill's view on financial supervision. I agree with that completely. I think the key thing to watch is the debt, the issuance, and what is happening at the long end of yield curves. Any involvement of central banks there is a huge red flag in a time when we have global economic activity, which is really very solid. And so I think that's the main red flag to watch.
I'm going to get to our parting shots, and I'm going to take that as a very good one from you, Robin. Thank you. 1 minute or so, parting shot. Jan, anything?
Nothing else from me.
Thank you. Bill? You're on mute, so.
No, I think I've said what I wanted to say, Alex. Thank you for the opportunity to be on the panel.
Thank you. Desmond, you get the last word.
I think that it would be better if Robin had the last word, to end it on an optimistic note. But maybe we should come back and revisit this. I should thank the panelists for their contributions, and maybe we come back and revisit this in 6 months' time, and hopefully everything will have panned out as well as the other panelists said.
Thank you, Desmond. Thanks to all the panel for a great discussion. Thanks to the audience for being with us, and for AEI for hosting us. Bye all.
Bye-bye.